Howdy, Wall Street Wooly. What is a line of credit? A line of credit, also known as an LOC, is a type of loan from a bank or financial institution where instead of borrowing the full amount up front, you can borrow as needed up to a certain approved credit limit. You only pay interest on the amount actually borrowed and can access the funds multiple times as long as you do not exceed the credit limit. Line of credit comes in handy during emergencies to cover unexpected expenses or if you start a project where the exact cost is unknown. How does a line of credit work? A line of credit is very similar to a credit card. The lender first needs to approve you for a certain credit limit based on your credit worthiness, your income, credit score, capacity to repay, outstanding debt, etc. While the exact requirements may vary by lender, someone with a credit score of 690 or more has a higher chance of getting approved with a high limit at a lower interest rate. Once approved, you can use the funds as you need them, only paying interest on the amount you actually use, not the entire credit limit. For example, if you are approved for a $10,000 line of credit, you can borrow $3,000 now for fixing your car, another $2,000 after a month for unexpected medical expenses, and still have $5,000 available to borrow. Once you repay the money you borrowed, your available limit goes back up to $10,000. The interest rate is generally variable and can change with changes in the market conditions. After you borrow, there is a mandatory minimum payment due each month, but you can pay more than the minimum to decrease your debt and save on interest, just like a credit card. Lenders may also charge a maintenance fee or annual fee that applies whether or not you use the funds. Are there different types of lines of credit? There are two main types of lines of credit, secured and unsecured. A secured line of credit is backed by collateral, and therefore has a higher credit limit and lower interest rate. Home equity line of credit, or HELOC, is a secured line of credit that uses your home equity as collateral. An unsecured line of credit is not backed by collateral, and therefore has more stringent requirements for borrowers to qualify. It usually provides lower credit limits with higher interest rates. One example is personal line of credit, or PLOC. Should I use a line of credit? That's a great question, Super Cooper, but that's a topic for another time. Thank you very much, Wall Street Wooly. You're welcome, Super Cooper. Remember, finance is your friend.